Welcome back to Analyst Bytes. In our last episode, we proved that in a perfect world, the group's bottom line profit remains the same regardless of the method. But the CFA exam isn't always that simple. Today, we are switching to head mode. We are going to tackle two variables that give candidates the biggest headaches: goodwill, the extra money paid, and internal transactions, those left-hand to right-hand trades. Mastering this is the only way to truly understand real-world consolidation. So let's jump straight into our first challenge, goodwill. First, the case info. I've kept the same framework from part 1. The fair value and book value differences are unchanged. If you haven't seen our foundation video on the equity method, acquisition method, and fair value amortization, I highly recommend watching that first. It will make this advanced version much easier to follow. Now, the only new variable, the purchase price. Take a look at this number, 750 million. Last time we paid 600 million, the perfect zero goodwill scenario. This time we are paying an extra 150 million. This premium is our main character, goodwill. Let's see how to calculate it under different standards. Let's look at the first question. Based on the background information, which accounting method should the parent company use? There is a small detail. Ownership is exactly 50%. In the real world, 50% can be a gray area. But remember, ownership is just a guide. It's not the absolute rule for control. This case clearly states the parent has actual control over the board. Since control is established, we must use acquisition method, not the equity method. I have summarized the logic in the chart below. You can use it to quickly review the different levels of influence, from no influence to significant influence, and finally to control. Now that the method is clear, let's get into the numbers. Now let's get to our first core topic. The question asks, under IFRS, which method results in the minimum goodwill, and what are the corresponding NCI and statement balances? Keep in mind, IFRS allows both full and partial goodwill. As the name suggests, partial only records a piece of the premium, so it naturally leads to a smaller figure. The logic here is actually identical to the equity method. First, we look at the fair value of the subsidiary's net assets. Assets minus liabilities, which is 1,200 million. Since the parent only bought a 50% stake, only half of that 1,200 million, which is 6 million, belongs to us. The amount the parent paid in excess of our share is the goodwill we are looking for, which is 150 million. For the NCI, it's very straightforward in this model. Since it doesn't share any of the goodwill, it simply takes its 50% of the net assets, which is also 600 million. But does the consolidated balance sheet still balance? Look at the consolidation process below. Step 1. The parent pays out 750 million in cash and brings in 100% of the subsidiary's assets and liabilities. Step 2. We plug in our calculated 150 million of goodwill and 600 million of NCI. You will see that both total assets and total liabilities plus equity stop precisely at 3,100 million. The accounting equation holds perfectly, and the question is solved. Now that we've covered partial goodwill, let's look at full goodwill. The third question asks for the goodwill and NCI under US GAAP. Remember this key point? Unlike IFRS, US GAAP only allows full goodwill. So this question is actually testing your mastery of that specific approach. The logic here is completely different. It assumes goodwill belongs to both the parent and the non-controlling shareholders. To find the full amount, we first create a 100% acquisition scenario. Step 1. Estimate the total fair value of the subsidiary. We take our purchase price and divide it by our ownership percentage, which gives us 1,500 million. Step 2. Calculate the full goodwill. Take that 1,500 million total value and subtract the sub's total net asset of 1,200 million. This gives us 300 million in full goodwill. Step 3. Find the NCI. Since the NCI now shares the goodwill, we simply take the total fair value and multiply it by the NCI percentage. In this case, that's 750 million. Let's check the consolidation process again. Step 1 is identical to the partial method. Cash drops by 750 million, and we bring in 100% of the sub's assets and liabilities. Step 2, we plug the full goodwill and the NCI into our table. You will see that both sides balance perfectly at 3,250 million. As you can see, the accounting equation still holds. Notice that because full goodwill captures the entire premium, the total assets are larger than under the partial method, and that full goodwill perfectly solved. Next, there is a crucial point about net identifiable asset you need to know. This question asks if the sub already has 200 million of goodwill from a previous acquisition, how much goodwill do we record under the full goodwill method? Take a look at this picture. You will see that the goodwill halo above the monster's head can't be picked up with the tweezer. Why? Because goodwill is based on future expectations. It can't exist independently. Therefore, it is not an identifiable asset and can't be included in our net identifiable assets calculation. So, in this case, the fair value of the subsidiary's net assets is no longer 1,200 million. We must exclude that 200 million of existing goodwill, adjusting the value to 1,000 million. Now, under full goodwill method, the new goodwill we record for the consolidated group becomes 1,500 million minus 1,000 million, which equals 500 million. The NCI calculation stays the same, 50% of the total fair value, or 750 million. Remember, identifiable assets must be capable of being sold separately. Since goodwill is just an attached value, it can't be transferred on its own. If you see goodwill on a subsidiary's books, always exclude it before you start. We perfectly solved this common trap. Besides consolidation, the curriculum mentions a special treatment for investment entities like VC or PE firms. This question tests that specific fair value method. Look at the question. What if Analyst buys is a venture capital firm? Do we still need to consolidate TechCo even if we have 50% control? For these entities, just to remember the key point in pink. Treat it exactly like an FVPL investment. The logic is just like tracking stocks in your personal portfolio. First, look at the parent company's separate balance sheet on the left. Since the investment is recorded at fair value, the amount on the book is simply its market value. In this model, goodwill never appears on the statements. Second, the subsidiary's net income is no longer linked to the parent. Just like owning Apple or Nvidia stock, you never record a share of their annual profits as your own income. Instead, you only recognize value in two ways. First, dividends. You only record dividend income and cash when the subsidiary actually declares a dividend payment. Second, fluctuations. As a financial investor, market price is everything. Whether the value goes up or down, you must record those unrealized gains or losses directly in your income statement. To sum it up, for fair value method, no consolidation, no goodwill, and your income only comes from value fluctuations and dividends. And that's all 5 goodwill-related questions perfectly solved. Finally, let's put full goodwill and partial goodwill side by side. On the left, under partial goodwill, our NCI monster doesn't share the premium. Notice that only the parent acquired assets, the blue tie monster, stands on that golden goodwill foundation. As you can see in the formula, partial goodwill is simply our purchase price minus our percentage share of the subsidiary's net assets. Because goodwill is only for the parent, the NCI stays simple. It's just its share of the net assets fair value. Now look at the right. Under full goodwill, the logic changes. Both monsters now stand on the foundation, share the value. The formula reflects this. We first find the implied total fair value by dividing our price by our ownership. We then subtract the subsidiary's net assets to get the full goodwill. Because of this, the NCI value also rises as it's now a percentage higher implied total fair value. That covers everything for goodwill. Our next module, internal transactions, uses a completely different logic, and the math gets more intense. I suggest you pause here for a quick water break. Once you're ready, we will dive back in. Now let's look at our next case. The background is similar, but with one crucial change. The parent company is using the equity method. Why? Because mastering internal transactions under the equity method is a core CFA requirement. Plus, it avoids the more complex elimination entries found in the acquisition method. We want to keep this as clear as possible. Here is the key transaction info. In Q4 2025, the parent sold goods to its sub for $100 million. The cost was $60 million. By the end of the year, the sub had sold 75% of those goods to outsiders, leaving the remaining 25% to be sold in Q1 2026. This is a classic intercompany transaction. While profit was recorded in 2025, a portion of it hasn't truly left the group. This creates a timing issue for our profit recognition. Now let's jump straight into the first question. Let's look at the downstream sale in 2025. Downstream simply means parent sales to the sub. Profit flows from top to bottom. Our goal is to find the adjusted consolidated net income. We need to figure out how the parent adjusts its share of profit from the subsidiary and what the final consolidated net income is. First, let's look at the individual books. The parent sold goods for 100 million with a cost of 60 million, recording a 40 million profit. The subsidiary bought those goods for 100 million and sold some to outsiders for 90 million. Since it only sold 75% of the inventory, its cost is 75 million. So the subsidiary recorded a 15 million profit. Here is a conflict, since only 75% of the goods actually left the group. 25 of that initial profit is still inside. It's just moving from the left pocket to the right pocket. This unrealized profit is 100 minus 60 times 25%, which is 10 million. Now we can calculate the parent's final net income. We start with the parent of 600 million net income and add our share of the subsidiary. For the subsidiary's portion, we take the sub's 100 million profit, subtract the 10 million in depreciation from our last video, and then subtract the 10 million unrealized profit we just found. Multiply that by our 50% stake, and the total consolidated net income comes to 640 million. But is this number right? Let's check the economic substance. Look at the pink section. For the entire group, the only real revenue is 90 million from the subsidiary's sale to outsiders. The actual cost for the group was the parent's original 60 million times 75% or 45 million. So the true profit contribution is 45 million. Let's do a final check. The parent's profit of 40 million plus the subsidiary's profit of 15 million minus the 10 million unrealized profit equals exactly 45 million. Two different perspectives, one identical result. Our calculation is correct, and the first question is perfectly solved. Let's look at the 2026 profit release. Once the subsidiary sells the remaining 25% of the goods to outsiders, how should the parent company recognize this income? The subsidiary's books for 2026 are quite simple. It received 30 million from the sale and recognized the remaining 25% of the cost. This results in a book profit of 5 million. Now you may ask, since the sub already recorded this 5 million, why do we need an extra adjustment? The key is the timing difference. In 2025, the parent recorded 100% of the revenue and cost on its standalone books, but deducted the unrealized profit during consolidation. By 2026, no new trades occur between them, so the parent's individual records stay silent. If we don't add back that 10 million profit from last year, this portion of the final sale will be missing from the group's total. This adjustment is essentially a release of the profit we suppressed last year. Let's check the group's view. The real revenue from the outsider this year is 30 million. The original cost for the group was 60 times 25%. So the final profit is 15 million. Let's verify this logic. We take 5 million profit from the subsidiaries report and add the 10 million profit that we locked away last year. Together, they equal exactly 15 million. Finally, we calculate the adjustment for the parent. Since the parent owes 50% of the subsidiary, we simply add back 10 times 50%, which is 5 million at the group level. And just like that, the profit release is perfectly solved. Now that we've covered downstream, let's switch directions to upstream. This is when the sub sells to the parent. The profit flows from bottom to top. You will find that the core logic is a perfect mirror image of what we just saw. Let's check the books. The subsidiary sells to the parent for 100 million, recording 40 million profit. The parent then sells to outsiders for 90 million. After deducting the 75% cost of purchase, the parent's individual profit is 15 million. The logic is identical, since 25% of the goods stayed within the group. That left-hand to right-hand profit must be eliminated. This unrealized profit is still 40 times 25, which equals 10 million. When calculating the parent's final net income, the formula will look very familiar. We take the parent's 600 million profit and add our share of the sub. We take the sub's 100 million profit, subtract 10 million for depreciation and 10 for unrealized profit, then multiply by our 50% stake. The result, still 640 million. Why are the numbers identical? Let's look at the economic substance. The group's only true revenue is 90 million, and the original cost was 45 million, so the true profit is 45 million. Let's verify. Parent's profit plus subsidiaries profit minus unrealized profit, which is 45 million. So whether profit flows up or down, as long as the sales ratio is the same, the impact on consolidated net income is identical. Upstream, perfectly solved. Okay, now let's look at the 2026 profit release from the upstream side. The parent's books are straightforward. It recorded a 5 million profit. But here is a big question. If the question is already on the parent's books, why do we need an extra adjustment? The reason is that in an upstream scenario, the profit we eliminated last year was sitting on the subsidiary's books. Since this sub isn't part of the trade this year, that 10 million in frozen profit would simply vanish if we didn't manually release it. Let's verify. Sales to outsiders are 30 million, and the original group cost was 15 million. This means the group's true profit is 15 million. Right now, we only have the parent's 5 million on the books. Therefore, we must add back the 10 million we deducted last year. 5 plus 10 equals 15. The logic is complete. Finally, based on our 50% ownership, we add back our share, 5 million, to the parent's statement. And just like that, every detail of these multi-period transactions is perfectly solved. Finally, let's wrap up with the core logic of internal transactions. Take a look at these two images. The one on the left represents the essence of this trade. Passing a cookie between family members doesn't make the family any richer. as long as the gold cookie is still circulating within the group. It's just a ghost profit and must be eliminated. Look to the right. Only when the cookie breaks orbit and hits the external market does it transform into gold. So remember this rule. If it's unrealized, eliminate the profit. Once it's sold to the outside world, add it back. This is the key to get your timing right. One final takeaway. Whether it's upstream or downstream, the distribution of profit might change, but the impact on the group's total net income is exactly the same. And with that, we've covered all the core concepts of internal transactions. There we go. We've officially broken down the core of intercorporate investments. If you have any questions about these cases or other topics in this chapter, just drop a comment. I will be sure to get back to you. In our next episode, we are switching gears to something more practical and fun. As a financial professional, do you ever feel like exploding because of a boss's absurd demands? Especially when money is involved, those requests can often be completely irrational. Take a look at these human nature binoculars. Next time, I will use them to observe those unreasonable workplace moments and diagnose the behavioral finance bias behind them. Whether it's loss aversion or overconfidence, let's take a vent and watch approach as we conduct a field survey of human irrationality. I'm Analyst Bytes. Every problem here is to help you ace the exam. Every insight is to help you see through the business world. Let's take the CFA out of the textbook and into your life. Thanks for watching. I will see you in the next one. Bye.